Let's bring in Bob Iaccino, the founder and chief strategist at Path Trading Partners, joining us to take a look at the numbers here this morning. Bob, welcome. I'd imagine, GDP growth in general over the next couple of weeks is going to be in focus after Powell's comments last week about above average growth leading to further rate hikes. What are the numbers this morning telling us?
Well, I guess I keep refreshing my screen here, and I must have a slow internet connection thanks to Hurricane Idalia or something, because I can't get the price index. That's what I was looking for. Obviously, we had the ADP numbers come out. They were weaker than expected. And this particular GDP, as you mentioned, it was higher than the first iteration of this, but it was lower than expected. Expectations, according to surveys, were about 2.4%, so it didn't come out as strong as expectations. All of that being said, though, the move we saw yesterday has been reversed, at least in the early morning, and not in its entirety on the rate side of things. So it's interesting. If you keep getting data like this, the Fed will change course in its language. And they haven't done that yet. When you looked at Jerome Powell, he wasn't overly hawkish at Jackson Hole, but he did say that unemployment is inconsistent with where we need it to be to get inflation to 2%. And he reiterated that essentially 2% is our target. And that's what we're going for, while a lot of people, Paul Krugman and the like, have been saying that the Fed should accept 3% inflation. But the interesting thing is, like, 2% inflation over 50 years is 100% inflation. So it's a mild target, but it's still prices going up. And that's what I keep trying to explain to people, that when you have it, which is why I'm trying to see the price index, and it hasn't come up on my screen yet.
Bob, why do you think we're seeing stocks rally, then rates come off here right now? Fed Chair Jerome Powell is basically telling us, hey, we're not there yet. We've got more work to do, and too early to declare victory.
So the market clearly doesn't believe him. I mean, if you look at the CME Fed Watch Tool last week, we had gotten the probability of an unchanged rate scenario at the September meeting, so no change in rates, last week was in the low 90s, high 80 percentile. Once we got the Jackson Hole speech, it dropped below 80%. Actually, people were starting to think maybe they're going to hike rates in September. Not a big group of investors, but they were there. We're back up to about 86 now. The market doesn't believe them. Also, there's a tab in the CME Fed Watch Tool. It's like 3 down, where you could, 2 down is compare, and you can see that the trajectory was coming down for an unchanged probability. It spiked back up after Jackson, or after the data that we got yesterday. And also, you go 1 down from that, and it's probabilities, and it shows a year and a half to 2 years out. Prior to the data that we got yesterday, and honestly, Friday to a certain degree, the probabilities were for, the highest probability was for rate hikes either in November or December. They weren't high, but it was the highest probability. They were in the 40 percentile. And the unchanged rates was in the 30, 2 rate hikes was in the 10s, et cetera. Now those are gone. Those are priced out. So the market has priced out any more rate hikes for this year. Again, not a big divergence, but still, they've priced them out. And you've now got the next rate move as being an ease, and that's what stocks are reacting to. Stocks have been reacting to the Fed, period. Also, what gold is reacting to is the lower, longer-term rate scenario that the market believes.
One could argue, hence the move lower in the dollar as well, right? And you've got a very hawkish tone from Christine Lagarde as well, a message where there's still significant work to be done there as well, or effort to be had. And inflation is significantly higher there also. So the data more supportive of that argument, that narrative as well, in terms of the market pushing back on some of the Fed expectations, maybe more buying into what they expect to see from the ECB.
Yeah, and the consumer confidence in the U.S. was a big, big drop, right? I mean, we're expecting 116. Previous was 117, and it was 106.1. So it was a big, big drop. So you combine that, and as you mentioned, hawkish words out of Christine Lagarde, and I expect the same out of the Bank of England, quite frankly, because they have the worst scenario where their economy is slowing down, but inflation is still double digits as of the last read. So you're looking at those two currencies being stronger. That is also, you and I have talked about this before, Ben, in terms of gold itself. Gold doesn't just react to the dollar, and it doesn't just react to rates. It's sort of a three-headed monster. And when you've got the dollar weakening and rates and sort of a lower trajectory, that's when gold really responds. That's what we saw yesterday. We saw the second strongest up day in August and the highest price levels since May. So we're looking at that particular scenario pointing to the market not believing Jerome Powell and the Fed.
Bob, it seems like the data this morning even more supportive of, again, that discussion in terms of believe the situation that's playing out in Europe and maybe push back a little bit on the U.S. Narrative. You've had stronger than expected CPI numbers out of Spain overnight. I saw the numbers out of Germany. It looks like we'll get some broader-based look at the EU tomorrow. But talk to me a little bit about the short end versus the long end, because not only in terms of the U.S. dollar, we've seen quite the shift as far as the 2-year and the focus moving away from that run-up we saw in the 10 and the 30 back towards that, again, shorter and closer tied to the Fed, and the move we saw to begin the week above 5%, but quite the reversal off that upper level.
Yeah, so number one, I just refreshed and saw the GDP quarter-over-quarter price index, and it came in at 2%. It was expected at 2.2%. The previous was 4.1. So that's some easing of price pressures there, right? We're still seeing, again, the 2% increase in prices. And if you look in, and I don't mean this as a political statement, I'm just meaning as a time marker, from when President Biden took office, prices are still up about 16.9% from that moment. So we still have consumers paying higher prices, which is why you see the divergence between the markets and what consumers may be saying on social media as to how they can't afford everything. But back to your question, the thing I like to see is the 2-year sort of go away, right? Sort of stop being the thing that we're talking about and talk more about the long end. Because for this uncertainty to end, we need the curve to be steep again. Right, so it's inverted, and it's very steeply inverted, with the 2s 10s around -75, the 2s 30s around -64, the 3-month 30-year is like 123. Those are all negative numbers, so it's steep, but it's in the wrong direction. Right, we need it to flatten out to zero and then go back to its normal shape, and then that will be the signal to markets that, you know, kind of all is well, kind of the all clear, the sun breaking through the clouds. And we keep getting this back and forth. Last week, we got a -63 on the 2s 10s. Then we went back to a settlement of -78. I've got us at -75 now, but I haven't updated post the numbers, so I don't know where it's at right now. So you make a great point. And do you mind if I comment on the BRICS really quick?
Go for it, Bob. Tell us what you're thinking.
Yeah, so the BRICS currency, I think your last guess was spot on about a number of things when you mentioned the BRICS. But I'd like to add something to that to again, ease people's minds that the dollar is for some reason not going to be the reserve currency in the near future. It's not going to get replaced, and I'll give you the main reason. And I got this from Jim Bianco, but I saw another sort of commentary on it earlier this week. You have the 2 leading opposition party candidates in Argentina saying that if they get elected, they will exit the BRICS. They will not accept the invitation. If it's already been accepted, they'll exit it. So political stability, even though our situation is not wonderful, it's still way better. And then you add in our secure legal and institutional structure and the liquidity, it's a long way off.
Okay, maybe no green shoots yet in terms of reversal of what we've seen in terms of the yield curve, but definitely seeing continued strength in terms of the U.S. dollar as the reserve currency, a global reserve.
Short term, I don't.
And definitely appreciate your thoughts here across the board in terms of currencies and treasuries, Bob, always. And a good look at the number. Appreciate your take on the GDP data as well, which is, again, very supportive of what we've been seeing in terms of, to Bob's point, economic numbers and supportive of this rally we've seen in the indices. Okay, that's Bob Iaccino, founder, chief strategist of Path Trading Partners.